Market is thinking that at most it will be 25 in May, assuming it was 25 in March, and chance of a 50, chance of a 25, I'm sorry, is only 32%. So this basically affected market's view of what Fed is going to do. If you want to simplify it, market thinks that Fed is going to increase 25 basis points this meeting and it's going to stop after that, at least for May, depending upon the future data. We can look at June as well. June contract is 95.19. Let me see where the meeting was. I think June 16th, but '14. Market is actually thinking that on the June meeting, there is no chance of a rate increase, and there's a likelihood of a rate decrease, assuming that between March and May meetings, there was a 125 basis points move. And chance of a rate decrease is actually 85. This is what markets assuming. I'm sorry, I didn't put power on. All right. Before the SVB collapse, the market was thinking there was going to be another 1 full point move between meetings in March, May, June, and July. Now it's at most 25, pretty much. So things changed quite a bit. More than likely, you could assume that there's going to be a recession, probably mild. Let's look at the yield curve. Let's look at the 3-month, 440, 30 year, 362. This is markets indicator for a recession, the reversion or immersion of 3-month to 30 years, even on 10 years, we have similar immersion as well. So market is kind of pricing a recession. Most of the drivers of the upcoming recession is going to be a credit crunch. Even though they prevented the contagion of the bank runs, what do you think small to mid banks are going to do? They're going to be very careful making risky loans. These are mortgages and what you want to call credit lines or loans to small to mid-sized businesses. And those guys, housing sector and small to mid-size is typically the drivers of the growth. So there's going to be a recession. And you could chalk this recession to A, lack of proper regulation, and B, greed of the bank executives. because those guys have stock options, right? When you have stock options, let's say if those bets on T-bonds were profitable, the value of the SVB stock was going to go up. And if you have stock options, as you can see, that guy had a right to buy it at 108. Okay. And we could pretty much figure uh, where that is. Let's see when it was 108. SIVB. This is trade halted at 106, but let's look at it 5 years. I mean, last time it was around 108. In fact, this was the lowest. Oh, it was about 10 years ago. And those options, one thing these guys are going to get away with, those options were going to expire this year anyway. Because typically they're granted at the end of the fiscal years. I don't know when SVB's fiscal year is. And they have a life of 10 years. And if they were not exercised by the end of 2023, they would have been gone worthless, regardless of where SVB was. But they could have waited until then. They just chose not to. Okay? And these guys actually just, let me look at 5 years. Just less than 1.5 years ago, the stock was trading at $700. These guys chose not to exercise those options at that time. That means they were expecting it was going to go much higher, but it didn't. So with the stock options, it's like flipping a coin. Tails we lose, heads they win. Okay. But unfortunately, if you're not regulating these big banks a lot more stricter, this sort of stuff is going to happen. And in economics, in dynamic economics, economic policy analysis, this is called time inconsistency. At the time you put a deposit limit like 250,000, you know for sure if this happens to a big bank, you're going to honor all the deposits. Because if you don't, consequences are going to be much worse. But even at the time, everybody knew that if something like that happened to a big bank or banks that are important to the system, where they could create systemic risk if they went down, those depositors were going to be saved. And that gives them a competitive advantage. Because I can tell my clients pretty much, and my clients are not stupid. If a bank of that size goes down, Fed is going to come in and honor those deposits, period. Versus a small bank, that may or may not happen. More than likely it won't. That means that small bank has to offer higher interest rates to attract the same client. But, as a bleeding heart liberal, I'm not surprised that the system is rigged that way. Even passing that limit of 250 was fought very hard. I mean, thanks to the 2008 crisis and the size of the Washington Mutual, and let's find out how big was WAMU when it collapsed. Yeah, 307 billion. So I guess 250 pretty much came because of to handle issues like WAMO, right? Their deposits were 108.3 billion, and they owed 83 billion to Federal Home Loan Bank. You know, and value of those loans, and they didn't have enough liquidity, and they were very competitive in credit cards and stuff. So these guys chose to take risks, both default risks and interest rate risks, and they had a basically implicit what the market calls Fed put. Okay, Fed basically covers the losses. That's kind of a preliminary autopsy for SVB. I don't know much about the Signature Bank, but more than 90% of their assets were 90% of their deposits were uninsured as well. So similar kind of things happened. So the lesson is as a regulator, I should put a extra capital charge for, in a sense, diversity of the deposits or the percent of uninsured deposits. If you exceed a certain threshold, I'm going to charge you a higher deposit insurance rate. So I'll give you an incentive not to exceed that. And if I don't think it will happen with this Congress, because Republicans are in official denial, even though they know exactly what happened. Had the Dodd-Frank been in place, it would have been much easier to cash this before it became a bigger problem. Or it's going to come out that all the T-bonds are going to be marked to market and sent to regulators on a daily basis. And they could actually do something about it. Something is going to come out of this, more than likely after the 2024 elections, depending upon who wins the election. I'll stop there. On Wednesday, we're going to start talking about cost of capital and things like weighted average cost of capital.